At the start of 2022, U.S. life and annuity insurers were navigating calm waters with a vibrant equity market, low inflation, and low interest rates. What a difference a year makes. I'm Lori Chortis for AM Best TV, and here to discuss AM Best's latest review and preview report on the life and annuity segment is Ed Kohlberg, a director at AM Best. Ed, welcome. Thanks so much for joining us.
Of course.
How has the Fed rates hikes impacted insurers, and is the frequency of the hikes a concern?
Yeah, sure. Certainly, the life and annuity industry is very much tied into interest rate movements, where they are and where they're going forward. So there are some immediate impacts, some impacts that maybe aren't as direct, that lag a bit, and we'll see later on. But ultimately, right, this is what the industry has been waiting for, an increase in interest rates, and here we are. It's here. Some impacts we're seeing right now, right? Net investment income has been up for the industry. You're seeing that bump in coupon rates and with new money being invested in bonds that have more favorable rates. But that will continue to move up and gravitate up, right? As those bonds or investments that have a lower coupon mature and roll off, and you can invest more new money, that net investment income will continue to increase. Certainly, right, with rates going up, products have become more attractive to consumers as they could get products with more rich crediting rates or guarantees that could be offered in this environment. So you're going to see some sales bump happening from that. Interest rates going up also creates alleviates some pressure that the industry has been feeling for a long time on legacy blocks of business that were sold years ago with more rich guarantees and interest rates crediting rates at higher amounts. So relieving that pressure is very good for the industry right now and in dealing with ERM programs. Investment portfolios, right? There might be a slight shift in strategy there in this new environment. The industry might not have to reach for yield as much in other investment classes that might be less liquid, or private type investments. Now they can get yields and rates that they require to back liabilities in the corporate bond market. So that's a benefit both from a balance sheet strength and ERM perspective. What's interesting is rate transactions in M&A, block reinsurance, or even acquisitions of legal entities. Right, in this environment, you might see a little bit of a shift there. It was been a very active M&A environment when rates were low, and companies felt the pressure on those legacy blocks of businesses, so they would look for options to reinsure them or sell them. Maybe now you could give those blocks a different look in this environment. And I don't think transaction M&A is going to go away. It's still a very robust and strong market, but it might be slowed down a little bit for now. Now, as for the frequency, right? You asked for the frequency. I think a step up is better than a spike, and you've seen kind of a step up, and companies have been able to prepare for that a bit. A spike is worse, right? You might have a run on the banks type scenario, which we haven't seen occur yet. But the challenge is always managing the unknowns, right, of where rates go up or down, and that's why ERM is important. It remains a key part of our analysis, and what we look at with companies and discuss with them is make sure that have ERM programs that are prepared to handle the environment that just happened and any certain unknowns that occur as well.
Are you seeing unrealized losses coming through in insurers' earnings?
Yeah, so unrealized loss position on the balance sheet has gone up significantly. As of third quarter 2022, it was at $20 billion, which is the highest level I could remember in recent years. It's being caused by bond value, the value of the bonds decreasing on the investments that you're holding that have a lower coupon. It's not worth as much now in the market, and also derivatives, right? Derivative hedge, unrealized losses run through that balance sheet line as well. So will it grow? Probably grow a bit more, but I think the worst of it, most of the pain has occurred already. I don't think the Fed's plan is to raise rates much more, although it certainly could go up more if you look at their plans for more the medium to longer term view is to bring rates back down. So it's all about managing that unrealized loss position in that period where you have those losses on your books. Right now it's more non-economic. Unless you have to liquidate those bonds. And that's why ALM is very important, right? Having well-matched liabilities against your assets, so you don't have to, when you liquidate some of those bonds in an unrealized loss position. And that's why persistency of blocks are important as well, and not having a run on the bank type scenario that would cause you to have to realize some of those losses. But as far as flow through the income statement, we're not seeing much of that now, right? Not on a material basis, at least. So for now, it's more non-economic. But the impact that we do have to watch and we're monitoring and dealing with is the impact of capital, because that unrealized loss position on a statutory basis does run through capital and surplus. Watching the year-end 2022 BCARs and RBCs is going to be important, not just where it ends at year end, but kind of what the expectation is going forward for those balances.
There was a sales spike in life and annuity products during the pandemic. With those conditions easing and the potential of a recession, do you expect to see a sales drop or perhaps a shifting?
Yeah, no, of course. We've seen that happen a bit already, right? For third quarter, 2022 versus third quarter 2021, we've already seen new analyzed premium decrease 5%. But bear in mind for the first 9 months of 2022 versus the first 9 months of 2021, overall it's up 6%, right? So the majority of the positive sales were in the first half of the year, 2022. Now the second half, right, sales have declined a bit from when they were at record levels. The increase in sales that we did see in 2021 in the first half of 2022 was certainly driven by the pandemic, right? As consumers did see a strong need for life insurance protection. Now with the recession fears coming into play, inflation, the battle for wallet share is very much there as consumers need to pick and choose where to spend their money. Certainly still very much a need for retirement and protection type products. The choice does become harder, especially for more commodity type products like term life. Even VUL, which was a variable universal life, was a growing product in the marketplace, so albeit off of a smaller base. With the equity markets not faring very well for the year, we saw a drop off in that product as well.
Do you think more intense economic conditions tend to create a more heated, competitive marketplace among insurers?
Yeah. I mean, it's already a heated marketplace, certainly, and I think for other certain products, this environment, ramps up that competition. Even more so in the low interest rate environment, we saw a lot of new players come into the market, right, and battling for being able to take on some legacy blocks of business or acquire assets in an opportunistic manner, in waiting for this rise in interest rates and reaping that benefit when that occurs. So that competition is already there, and a lot of new players and new entrants, and now right, they're competing in a different environment where they can offer higher crediting rates and becomes very competitive. But for now, there's enough to go around, right? There's certainly enough business to go around. There is very much a need in the industry for retirement and protection type products. As I said, that's not going around. That's not going away anytime soon. There are pockets of more intense competitions that we see here or there. So it definitely bears watching. Because there certainly could be winners and losers. Some of those that came in a different environment and seeing how the markets and cycles change. We like to see how companies are performing in this new cycle, right? It's been interesting, last few years, and it'll continue to be interesting for sure.
Well, looking at 2023, what are some of the key metrics, like, for example, liquidity, that you think bears close watching?
Yeah, there are a lot of metrics that we look at, right? Some are certainly more important in other environments than than others. First and foremost is capital, right? I mean, capitalization is important. Volatility of capital. We like to see companies that can grow capital organically. The BCAR model is important, and the RBC models are very important as well to make sure companies have capital levels and excess capital levels to maintain current policyholders and to maintain growth projections as well. I mentioned ALM, and right, ALM is very important in a current environment. I think previously, ALM was still there and looked at, and there was reasons for mismatches, right? As companies didn't want to lock in on assets in a rate environment where rates were lower, right? Didn't want to lock in for lower on their investments. But now there's been more of a focus on getting a tighter match in ALM now that you could get assets that better back long-term liabilities. So that's important. Leverage is important as well. Right? It might not be as much of an incentive to leverage up your balance sheet with rates where they are today. We saw a lot of opportunistic leveraging up in previous years when rates were low. Now if a company gets in trouble with selling too much and having strain and trying to fill a gap on their capitalization with leverage, they might be paying for it more now with higher rates. And then lastly, ERM, right? I think it's important to mention ERM again because that's the key in cycles, is making sure that a company has a tight ERM and they're looking at different stress test scenarios, different areas where their risks might be more honed in or impacted in the current environment, and being able to be well prepared for what happens in the future is important as well.
Ed, thank you so much for speaking with us today.
Sure, of course. Thank you.
That was Ed Kohlberg, a director at AM Best. For AM Best TV, I'm Lori Shortis.